Now it's time to bring in our halftime headliner. We're talking about Ed Yardeni of Yardeni Research. Ed, it is great to have you here on a day like this to talk inflation and the impact on the market. How are you today?
I'm fine, thank you.
All right, big question here. What does the CPI read mean for the economy, and what does it mean for the markets? Obviously, two separate things.
Well, I think certainly with the benefit of hindsight, it seems that inflation has turned out to be somewhat more persistent in some areas and transitory in other areas. So it hasn't been just across the board persistence. In fact, we've seen a very transitory situation in the goods markets. Goods inflation has come down rather dramatically, down basically to zero. Now I think we're starting to see disinflation in the services side, particularly the rent component, which is 40% of the CPI. So I think that inflation continues to moderate. I think some of the inflation we've had was related to the pandemic, the shocks of the pandemic, and they're dissipating. And as we move forward here, I think inflation concerns will abate as an impediment to a continuation of economic growth. I mean, we did have a mini recession back there in 2020. I think we're still in an economic expansion. I think we've been in a rolling recession. If we've been in a recession at all, it's been a rolling one, and now I think we're in a rolling expansion.
All right, so Ed, you're saying inflation concerns abate. Is that for the market? Is that for the consumer? Is that for the Fed? We had several Fed speakers out today, Kashkari, Barkin, both of them saying post-CPI, inflation is still too high. Are you listening to those hawkish voices? Is there another Fed speaker that you're listening to for insight?
Well, now they seem to sort of have a split personality when it comes to what they're doing. On the one hand, when they get together as a committee and put out the projections of the summary of economic projections where they put in their forecasts, they've been really forecasting for some time that they would get the Fed funds rate up to 5.5%. And that would be restrictive enough that if they left it there, that inflation would come down. So I guess they don't want to use the expression mission accomplished because that's a jinx. But I think to a large extent they have achieved their mission, which was to get the Fed funds rate up to a restrictive level and keep it there. I'm not in the camp that thinks the Fed funds rate's coming down anytime soon. I think they've done a pretty good job. And I know it's usually a jinx as well to side with the Fed, but I think this time the Fed may actually have gotten it right.
You know, I think a lot of people say don't fight the Fed. Ed, Joe Terranovi has a question for you.
Ed, good to see you. So a lot of times, you know, when you think about personal goals, you say to yourself, I want to do 20 more push-ups over the next year. Well, the first 15 you might be able to do pretty quickly, and the next 5 get really tough. And I think that's how we think about inflation right now. You've gotten to 3%. It's going to be difficult to get 2%. Ed, you're a student of history. Can equities and risk assets live in a world where inflation stays sticky at 3%?
Well, if inflation stays sticky at 3%, then basically we're back to the old normal. Before the Fed was concerned that they couldn't get inflation up to 2%, I think we could live with 3%. I think the bond yield would be around current levels, and I think earnings would continue to grow. But I do believe that inflation actually could continue to come down to 2% because I guess I'm in the roaring 2020s camp. I know that seemed delusional here for the past few years, but I think it's still very much a realistic possibility that we're going to see technological innovations, not just AI, but a whole slew of technologies that get integrated together that apply to just about every business model you can come up with. I think every company now is, in a sense, a tech company. If they don't make tech, they're going to use tech to increase their productivity and efficiency.